Okay guys, welcome back to the next lesson. This lesson is about liquidity and trendline liquidity. Okay, so why we don't trade support and resistance, basically part 2, and why we don't trade with trend lines. Okay, why we don't trade with trend lines. Okay, so let's take a look at this market and let's play this market. This is US 30. Okay, if you guys don't know what US 30 is, it's the top it's the top 30 US companies put into one stock. Okay, so let's now play this market. So this is our first point of liquidity. Remember what we said? We said liquidity is an area where a lot of money is lying in the market. So let's take our trend line tool, or line tool in this case. We're going to hold down shift and we're going to make it straight. So that's the first point that the market needs to come back to in order for there to be a major move in the market. Okay, in order for the market to carry on, because right now the market is bearish. In order for the market to carry on dropping, price must come back to this point, take liquidity, i.e. hit retail traders stop loss before it continues down, which is why we don't trade retail trading. Another point of liquidity is this point in the market right here. So these 2 points in the market need to be taken out, meaning what? There are retail traders here who have sold the market from here. Okay, so they have been in sales. Okay, so they were in sales from right here, okay, from this first point here, and people were also in sales from this point here, this line here. Okay, the stop losses are above here, for example, and the take profits are lower. Okay, so we're waiting for these points to get taken out. Okay, so this is called a liquidity grab. What you're about to see is a liquidity grab. So in order for the market to continue down, remember, there has to be for every time, in order for there to be a seller in the market, in order for there to be a buyer in the market, there has to be a seller, and in order for there to be a seller in the market, there has to be a buyer. So in this case, the transaction is about to take place. So the retailers are about to sell their money to the big banks, the corporations, etc., the smart money concept traders, in order for the price to carry on going down. So let's play this market and see what happens. Okay, so anytime now, okay, price goes down. What happens here is liquidity was taken from this point first. No problem here. This was a point of liquidity. So price came up, price pulled back, it formed this area of liquidity here. So what happens is price came and pinched all of the stop losses from the traders that were trading from this level. Okay, so what happens is price, their stop losses would have been where? Right above here, just above the highs of the mini resistance. Why? Because price stopped here. Because price stopped here, retail traders are seeing this as resistance. So in our case, what do? We're simply still waiting. We are waiting because we believe this is not the real long-term move. Why? Because these 2 points of liquidity have still not been taken, and sometimes, guys, your points of liquidity that you mark out, they might not get taken straight away, just like you've seen it in this example here. A new area of liquidity might get formed first, just like this area that we had over here, and then as soon as the price touches it, it will and takes people's stop loss from here, then the price will move. Why? But look, the major move, this big move over here, this big drop didn't happen until the liquidity from the retailers were taken from here, and now there's still retail traders in the market here, there's still retail traders in the market at this price point here. So what we're waiting for this liquidity to now be taken, we're waiting for this liquidity to now be taken, and we're waiting for this liquidity to now be taken. That might all happen at the same time. Okay, so for example, this liquidity might get taken first. So what we're waiting for right now is we are waiting for the price to come up past this level here, come up past this level here, then have a bit of a drop, and then eventually come up past this level here and then have a drop. Okay, probably drop from around somewhere here because this is an area of inefficiency. We're going to speak about inefficiencies in later videos. Okay, so let's play the video, let's play the market, let's see what happens. Okay, boom, first liquidity taken. So now the previous liquidity, okay, has now become new liquidity. So this high of the market, what happens is all the traders that got in here, they moved their stop loss to break even. They've all got stopped out. Why? The market came back to stop hunt them. It took their stop losses. So now what are we waiting for? We are waiting for, okay, we can delete that now. We can delete this, we can delete that. We are now waiting for this area of liquidity to be taken out. Let's play the market. Okay, so what can we now see? We spoke about trendline liquidity, right? So over here, retailers love trend lines, guys. They love a line of best fit that is going up. Okay, they love a line of best fit that is going up. And whenever the price touches the trend line, what they do is they buy whenever the price touches the trend line, and they place their stop loss below the lows of below the previous low, which in this case is over here, right? And their take profit might be all the way up there, okay? For example, their take profit will be all the way, for example, here, okay? So let's see what happens. Okay, cool. Whenever price comes down, trend line, it goes back up. Okay, so there's more retail traders buying here. I want to show you guys something. Their stop losses go where? Below here. So cool, play the market again. Price touches the trend line. Okay, we're waiting, okay? Price touches the trend line. Okay, it goes up from there, no problem. So retail traders are buying again at the trend line. The take profit might be all the way up there. Now let's see what happens, guys, okay? The stop loss is below the last low, which is here, okay? Below, their stop losses are gonna be where? Below this last low right here. So for them, this means their trade is protected, okay? So now, what smart money concepts does is it takes the liquidity. This is called trend line liquidity. Whenever you see a trend line, do not buy, even though price is going to go up from there, even though price might drop from there. This is a retail trap. Watch guys. In a minute you're going to see price melt, and you're going to see people get stopped out. Boom. All the people that were buying here, what happened? All their stop losses got taken. And this is an introduction to liquidity and trend line liquidity, and why we do not trade it. We're going to get into more liquidity and trend line liquidity as we progress with the course, but that's a prime example as an introduction.